Dear viewers, Drishti IAS welcomes you to the new series of To The Point. Today's topic of discussion is Standing Deposit Facility. First of all, let's see why is it in the news. Recently, the Reserve Bank of India, that is RBI, introduced the Standing Deposit Facility, that is SDF, an additional tool for absorbing liquidity at an interest rate of 3.75%. Now let's discuss what is SDF. In 2018, the amended Section 17 of the RBI Act empowered the Reserve Bank to introduce the SDF. SDF is an additional tool for absorbing liquidity without any collateral. By removing the binding collateral constraint on the RBI, the SDF strengthens the operating framework of monetary policy. The SDF is also a financial stability tool in addition to its role in liquidity management. The SDF will replace the fixed rate reverse repo, that is FRRR, as the floor of liquidity adjustment facility corridor. Both the standing facilities, the MSF, that is marginal standing facility, and the SDF will be available on all days of the week throughout the year. Now let's understand how will the SDF operate. The main purpose of SDF is to reduce the excess liquidity of Rs 8.5 lakh crore in the system and control inflation. The SDF rate will be 25 BPS below the policy rate, that is repo rate, and it will be applicable to overnight deposits at this stage. It would, however, retain the flexibility to absorb liquidity of longer tenors as and when the need arises with appropriate pricing. The RBI's plan is to restore the size of the liquidity surplus in the system to a level consistent with the prevailing stance of monetary policy. Now let's discuss about the instruments of monetary policy. First is repo rate. Repo rate is the rate at which the central bank of a country, RBI in case of India, lends money to commercial banks in the event of any shortfall of funds. Repo rate is used by monetary authorities to control inflation. Next is reverse repo rate. Reverse repo rate is the rate at which the central bank of a country, Reserve Bank of India in case of India, borrows money from commercial banks within the country. It is a monetary policy instrument which can be used to control the money supply in the country. The marginal standing facility or MSF refers to the facility under which scheduled commercial banks can borrow an additional amount of overnight money from the central bank. It is done by dipping into their statutory liquidity ratio, that is SLR, portfolio up to a limit at a penal rate of interest. This provides a safety valve against unanticipated liquidity shocks to the banking system. Now it's time for the practice question. Consider the following statements. 1. The standing deposit facility, that is SDF, is an additional tool for creating more liquidity. 2. Repo rate is the rate at which the RBI lends money to commercial banks in the event of any shortfall of funds. Which of the above statement or statements is or are correct? 1 only, 2 only, both 1 and 2, or neither 1 nor 2? Send the answer of this question in the comment section. Stay tuned for the next episode. Thanks for watching. Have a great day. Dear viewers, watch this topic in Hindi on our Drishti IAS Hindi YouTube channel.